In this video, we'll be talking about accrued expenses, and then we'll summarize the two types of adjusting entries, the prepaids and the accrueds. This is from the PowerPoint presentation for Chapter 3. In this slide, Smart Touch Learning is paying its employees bi-monthly, so you have the 15th and the 1st, and it pays a monthly salary of $2,400 split between the two pay periods. On December 31st, the financial statements become due. Notice that on December 31st, they have not paid salaries for the latter half of the month. So they still owe $1,200. Now this salary expense has accrued over the last 2 weeks of the month, and yet no cash is exchanged hands yet. So the adjusting entry, when the financial statements are prepared, you have to show that you have an obligation. So you debit salaries expense for the latter half of the month, $1,200, and you credit salaries payable, which is the liability, which in this case will be paid off the following day. But notice when we prepare the financial statements, they are as of December 31st. Accrued revenues work very much the same way. In this case, you have earned something over the period, but it hasn't been accompanied with an explicit transaction. So for example, here you agreed to perform e-learning services for $1,600 per month. Customer probably will pay you after the first month, but by the end of December, you've earned half of the monthly fee, but you haven't received any money yet. So when you prepare the financial statements, you have to recognize the fact that you have an accounts receivable and service revenue that's accrued. Later, when you get the cash, the receivable will go away and the transaction will be complete. Once we understand adjusting entries, we'll be able to prepare an adjusted trial balance, and that will be in a subsequent video. So what I'd like to do now is kind of summarize prepaids and accruals. This spreadsheet kind of lists the issues that we've already talked about. The key element here is that we're starting out in the previous period here. The adjusting entry is happening today, so this is when the financial statements are actually being prepared. And then we have a later period that will apply when we get to accruals. For all of our prepaids, like we said, the cash event occurs before, and the adjusting event is happening today. So with the prepaid service expense, we've got a debit to expense and a credit to cash. That happened in the past. For example, you could have bought a magazine subscription a year in advance. The expense happens when you recognize the fact that the time has elapsed and the magazine subscription has gone away, or in this example with a short-term asset like supplies, at the end of the year, what's happened, we've used some of the asset, so we've recognized an expense. In both cases, the debit is to an expense, the credit is to the asset that was created at the beginning. With long-term assets, we purchase equipment or something else long-term that we depreciate, and like we said in the previous video, the debit is to depreciation expense, and the credit is to a contra asset account called accumulated depreciation. On the revenue side, you can get prepaid for revenue. In this case, we get cash at the beginning of the period earlier, and we recognize a liability called unearned revenue, and then as time passes, we debit the unearned revenue and credit revenue for the period. So that's our prepaids. The key again is that with all prepaids, the accounting event happens after the cash event. You get the cash, and then you have to recognize the revenue or expense later. With accruals, it's the opposite. The accounting event happens now when the adjusting entry is made, and you get your cash subsequently. So for example, we saw a situation where the firm owed employees money and they hadn't paid their salaries yet. So we have salary expense and salary payable. Later, when they pay the salaries, you'll debit the expense and credit cash. You'll debit the payable and credit cash. With accrued revenues, you've performed a service but haven't gotten paid yet, so you recognize some sort of receivable and you credit service revenue. Later, when you actually get the money, the receivable goes away. Notice that all accruals are accompanied either by a payable or by a receivable, depending on whether they are revenues or expenses. So again, two classes of adjustments. Prepaids, the cash event happens first, the accounting event happens second. Accruals, the accounting event happens first, the cash event happens second. And that's our prepaids and our accruals and our adjustments in Chapter 3 in a nutshell.